I want you to memorize two numbers, 27, 22. 27 is the percentage of the world's total official foreign reserves that was sitting in gold at the end of 2025. 22 is the percentage that was sitting in United States Treasury securities. Those numbers do not come from a newsletter or a bullion dealer. They come from the European Central Bank from its annual review of the international role of the euro, published on the 2nd of June 2026. Hold those two numbers in your head because the last time they were arranged in that order, the last time gold outweighed American government debt on the books of the world's central banks was 1996. Every major outlet that covered this told you the same story. They told you it is a story about the price of gold. That reading is not just shallow, it is dangerously wrong. This crossover is not a price event. It is a change in who owns the debt of the United States. That change has a mechanism, it has a timetable, and it has a physical location, and I am going to show you all three. I am also going to show you what happened in the 3 years after the last crossover in 1996, because that is the part nobody has told you at all. On this channel, we do not do panic and we do not do cheerleading. We follow the logic of power. We follow the incentives. And when you strip away the emotion in the headlines, the picture always becomes clear. Here is my thesis, and I'm going to lay it out plainly. I am going to show you exactly three things. First, that most of this crossover is arithmetic rather than revolution, and I am going to concede that to you in the first 5 minutes rather than hide it, because what survives that concession is the only part worth your time. Second, that the real signal is not in the gold column at all. It is in the custody column at the Federal Reserve Bank of New York, and it moved by $82 billion in a single month this year. Third, that both of those facts are produced by one structural process, which I am going to name for you now and use for the rest of this analysis. I call it the sovereign handoff. The buyer of last resort for American debt is quietly changing identity, and the total keeps rising while the identity changes, which is exactly why almost nobody has noticed. If you want to follow this story as it develops, subscribe to the channel. This format answers one question, which is what is happening. The question of what you do about it in your own household is a different question, and that is what the Crisis Preparation Blueprint is for. Open it in another tab now, because I am going to come back to it at the end of this analysis. The link is in the description and in the pinned comment. Let me start with the facts, because you need the ground beneath your feet before I take you into the analysis. On the 2nd of June, 2026, the European Central Bank published its 25th annual review of the international role of the euro. In it, the ECB reported that gold's share of total official foreign reserves reached 27% at the end of 2025, ahead of United States Treasuries at 22% and ahead of the euro at 15%. In the foreword, ECB President Christine Lagarde wrote that geopolitical tensions continue to drive strong central bank demand for gold. The same report put central bank gold holdings above 36,000 tons. The crossover itself was first flagged 9 months earlier. On the 27th of August, 2025, using Bloomberg data, Ottavio Costa of Crescat Capital published a chart showing foreign central bank gold holdings passing their United States Treasury holdings as a share of reserves for the first time since 1996. Gold cleared $4,000 an ounce for the first time in October 2025. It finished 2025 up roughly 60% on the year after a gain of roughly 30% the year before. Then came January. On the 26th of January 2026, spot gold passed $5,000 an ounce for the first time. 2 days later, it set its record, reported between roughly $5,540 and $5,610, depending on which reference you use. The London bullion market's afternoon benchmark peaked at 5,405. Since then, it has fallen, The second quarter of 2026 was gold's steepest quarterly decline since 2013. As I record this in the middle of August 2026, gold trades in the region of $4,400 an ounce, roughly a fifth below the January peak. Now, the other side of the ledger. The Congressional Budget Office, in its February 2026 baseline, put gross federal debt at $38.6 trillion, the deficit for fiscal 2026 at $1.9 trillion, and net interest at $1.0 trillion, which is 3.3% of gross domestic product. That interest figure exceeds the previous post-war record of 3.2% set in 1991. The 10-year Treasury yield sits near 4.65%. The 30-year yield is above 5.2%, which is a 19-year high. The federal funds target range is 3.5 to 3.75%. Headline consumer price inflation in July was 3.4%. Now here is the part the headlines skip: the sovereign handoff. Here is the definition. The total volume of foreign money financing the United States is at a record high, and the composition of that money has changed underneath the total. Official institutions, meaning central banks and sovereign funds, are stepping back. Private institutions, meaning funds, dealers, and leveraged traders, are stepping forward and filling the gap. The headline number rises. The character of the money underneath it changes completely. Here is the kitchen table version. Imagine you own a building with 20 flats. Every flat is occupied. Occupancy is 100%, exactly as it was 10 years ago, and your rent roll is the highest it has ever been. On paper, you are doing better than ever. But the tenants who lived there for 20 years, who paid on the first of the month through 2 recessions and never once asked for a discount, have quietly moved out. They have been replaced by short-stay guests who will leave the moment a better rate appears 3 streets away. Your occupancy did not change. Your risk changed entirely. That is a story you could explain to your spouse in 30 seconds. But that explanation is too simple. Take it one level deeper. The new tenants are not merely short-term. Many of them are paying your rent with borrowed money. They hold your building because the spread between what they earn on it and what they pay to fund it is currently positive. They are not holding it because they believe in the building. They are holding it because the financing is cheap, which means your occupancy is no longer a judgment about your building at all. It is a judgment about the credit market that funds your tenants. When that funding tightens, your flats empty in days rather than years, and nothing about the building will have changed. That is the sovereign handoff, and now let me prove it to you in 4 layers. Layer 1 is the obvious evidence, and you may already half know it. Central banks have been accumulating gold at a pace unseen in half a century. The ECB reports purchases above 1,000 tons a year from 2022 through 2024, easing to around 850 tons in 2025. Since Russia's full-scale invasion of Ukraine in 2022, China has bought more than 350 tons, Poland 320, Turkey 220, India 130. The trigger for that behavior is not mysterious, and no serious analyst disputes it. In February 2022, Western governments froze roughly $300 billion of Russian central bank reserves. Every reserve manager outside the Western alliance drew the same conclusion on the same afternoon. A reserve asset that can be switched off by the country that issues it is not a reserve. It is a permission. Do the arithmetic with me on what that permission is worth. Gold at 27%, Treasuries at 22, 5 points apart. Now strip out the price move. The ECB did this itself, holding gold at its end of 2023 price. On that basis, gold is 16% and Treasuries are 26, 10 points apart in the opposite direction, a 15-point swing produced mostly by price. Layer 1 is real and Layer 1 is mostly arithmetic. Stay with me because Layer 4 is the part almost nobody has connected. Layer 2 is the hidden evidence. It is public. It is simply not covered. On the 30th of July, 2026, the World Gold Council reported that central banks bought a net 289 tons of gold in the second quarter, the strongest second quarter in its data series, up more than 60% on the same quarter a year earlier. Now put that against the price. That was the quarter gold fell hardest in over a decade. Reserve managers did not buy the rally, they bought the decline, and they accelerated into it. Poland added 51 tons and reached 632 tons against a stated target of 700. The People's Bank of China added 33 tons, its largest quarterly addition since late 2023, taking reported holdings to 2,346 tons. Do the arithmetic with me. 289 tons is about 9.3 million troy ounces. At $4,000 an ounce, that is roughly $37 billion in a single quarter. And I will give you the number that ought to be in every write-up of this story and is in almost none of them. In 2025, the largest single gold buyer among central banks was Poland at about 100 tons. The stablecoin issuer Tether bought more than 100 tons in the same year. A private token issuer accumulated gold at sovereign scale. Let that sit. Layer 3 is the connective evidence, the layer that ties the others together in time. Geography is where the truth always lives, so let me locate this story physically. It lives in the Strait of Hormuz. When war broke out in the Middle East, the Turkish central bank sold or loaned out about 130 tons of gold, one of the largest reserve drawdowns in recent years, to defend its currency and pay for energy. Settlement volumes on China's cross-border interbank payment system rose by more than a third in the days around the outbreak. The ECB reports that some ships made payments in renminbi through that system or in crypto assets in order to transit the strait in March and April of 2026. Now hold March in your mind because three things happened in that 1 month. Ships began paying for passage outside the dollar system. Treasury auctions for 2, 5, and 7-year notes cleared badly, with primary dealers forced to absorb about 24% of 1-2-year sale, roughly twice their normal share, while the 10-year yield rose from 4% to 4.4%. And the value of United States Treasuries held in custody at the Federal Reserve Bank of New York on behalf of official institutions fell by $82 billion in that single month to $2.7 trillion, the lowest level since 2012. 1 month, 3 events, a payment corridor, an auction, a custody account. Layer 4 is the structural evidence. Here is where intent becomes visible. Through all of this, foreign holdings of treasuries did not fall. They reached a record, above $9.4 trillion in early 2026. But look inside the flow. In February, private foreign investors bought a net $147.3 billion of long-term United States securities, while foreign official institutions sold a net $46.1 billion. In March, officials sold again. In May, private inflows ran at $172 billion, while official flows ran out at $39.9 billion. The building is full. The tenants have changed. And around that substitution, the architecture is being poured. On the 1st of February, 2026, President Xi Jinping publicly called for the renminbi to become a global reserve currency. On the 14th of February, the ECB made its EUREP liquidity facility permanent and global so that any qualifying central bank on earth can borrow euros in a crisis without asking Washington. India has proposed linking central bank digital currencies across the BRICS group. That is not an accident. That is architecture. Now, before I continue, I want to present the strongest possible argument for the opposing side because I owe you the real debate, not a simplified version. The counter case is serious, and it comes from the ECB itself. The report that produced the 27% headline also says, in its own words, that the development largely reflects valuation effects. Gold rose 30% in 2024 and 60% in 2025. If you simply hold the price constant at end of 2023 levels, gold and the euro are level at 16% each, and treasuries remain far ahead at 26%. On that measure, nothing was overtaken. Nothing was sold. A number went up because a price went up. Second, the currency composition of reserves has barely moved. The dollar's share of allocated foreign exchange reserves is around 57% and stable. The euro is around 20%. The renminbi is close to 2%, which is not the profile of a currency about to inherit the world. Third, the premium investors pay for the convenience of holding treasuries, which is the cleanest measure of how special that asset is, was around 190 basis points in 2025 and unchanged from the year before. German government bonds earn about 90. Fourth, the auctions mostly work. Bid-to-cover ratios across the curve remain close to their 5-year averages. Fifth, in a survey cited by the ECB, more than 2/3 of central banks that had explicitly built geopolitical risk into their reserve management made no change to the currencies they invest in. Sixth, gold pays you nothing, costs money to store, and just fell about 20% in 6 months. And I will be honest with you, the valuation effect is real. It is the largest single driver of the 27% number, and anyone who tells you otherwise is selling you something. But the steelman cannot explain the 289 tons. It cannot explain why reserve managers, in the single worst quarter for the gold price in more than a decade, bought more of it than in any second quarter on record. Price-insensitive buying is not portfolio management. It is insurance. And the steelman cannot explain why the custody account at the New York Fed drained to a 14-year low in the same season that private demand hit an all-time high. The steelman describes the surface. It does not describe what lies beneath it. Let me bring this together with 3 predictions. Write these down. Come back to this video in 90 days and tell me whether I was right or wrong. Prediction 1 is near-term and specific. The World Gold Council publishes gold demand trends for the 3rd quarter at the end of October 2026. I predict that report will show official sector net purchases above 200 tons for the quarter, with China and Poland again among the named buyers. And I predict it will do so regardless of which way the gold price moves between now and then. The named trigger to watch is the September meeting of the Federal Open Market Committee. If that committee raises rates and the gold price falls in response, and official purchases still print above 200 tons, the price insensitivity thesis is confirmed in public data. Prediction 2 is midterm and structural, and it is tied to a threshold. In the ECB's next annual review, due in June 2027, I predict gold's share of total official reserves will still be reported above the Treasury share, and specifically will not fall back below 22%, even if the gold price never regains its January high. That is falsifiable in one line of one table. If the gold price falls another $1,000 and the share still holds, the driver was never price alone. Prediction 3 is the absence prediction. Watch for what they do not say. That silence is a signal. I predict that no serving United States Treasury Secretary, no serving Federal Reserve Chair, and no G7 Finance Ministry will describe this reserve shift in an official statement as a decline in confidence in United States government debt. They will use 3 words instead: diversification, valuation, prudence, and I predict something more specific. They will not name the February 2022 asset freeze as a cause. That freeze is the single most cited explanation among the reserve managers themselves, and it will remain the one explanation that official Washington does not utter, because to name it is to concede that the instrument worked and had a price. Here is what to watch, and I want to give you 3 specific things. First, the Treasury International Capital release, published monthly by the United States Treasury with June data due on the 17th of August. Ignore the headline inflow. Go to the split between foreign official and foreign private. The gap between those two lines is the sovereign handoff measured directly. Second, the Federal Reserve Bank of New York custody series, published weekly, which shows treasuries held for foreign official accounts. It fell $82 billion in March to the lowest level since 2012. Watch whether it recovers or whether 2.7 trillion becomes the new ceiling. Pair that with the primary dealer take at each 30-year auction. When dealers are absorbing well above their usual share, the marginal buyer has stepped away. Third, and this is the one on the list you actually control. Look at your own household the way a reserve manager looks at a portfolio. Not what you own, but what you are exposed to. How much of your savings depends on a single currency, a single government's borrowing costs, and a single interest rate path? Whether your liabilities are fixed or floating, because floating liabilities are the household version of short-term funding. And what share of your monthly spending moves with energy prices, given that the Strait of Hormuz is currently pricing your electricity bill? You cannot change the reserve system. You can measure your own exposure to it, and almost nobody does. The analysis tells you what is happening. The blueprint tells you what to do about it. That is the division of labor on this channel, and it is deliberate. Geopolitical analysis almost never includes the personal finance chapter because the analyst does not live in your house and does not know your obligations. The crisis preparation blueprint is that missing chapter. It is a framework for auditing your own exposure, your own liquidity, your own dependencies in the same disciplined way an institution audits its reserves. The link is in the description and in the pinned comment. Now let me leave you with the history, because there is an empire in this story, and it is not the one you expect. Sterling was the reserve currency of the world. On the 18th of September, 1949, Britain devalued the pound from $4.03 to $2.80, a fall of about 30%. 18 years later, on the 18th of November, 1967, it devalued again to $2.40. Britain did not lose its monetary position in a crash. It lost it in two announcements, 18 years apart, each one described at the time as a technical adjustment. Now return to the open loop. What happened after the 1996 crossover, the last time gold outweighed treasuries? Gold peaked near $415 early that year, then fell more than 20% in 1997 and reached a 20-year low near $253 in 1999. In December 1997, the Financial Times published an article titled "The Death of Gold." The crossover in 1996 did not predict the gold price. It marked the beginning of the era it ended. Here is the question I cannot answer for you. If a crossover marks the start of a regime rather than the direction of a price, what regime started in 2025? The most dangerous monetary shift is not the one that arrives as a crisis. It is the one that arrives as a rounding error in a footnote and is filed under valuation effects. If this helped you understand what is actually happening beneath the surface, subscribe to the channel. Tell me in the comments which of the 4 layers concerns you most: the gold accumulation, the tether purchase, the March custody drain, or the private money that has quietly replaced the sovereigns. I read your responses, and your questions shape the next analysis. Thank you for watching.